Wow, that was quite a bull rally this week, wasn't it? Thank God I don't short the markets. Okay, maybe I shorted the markets. So this week's rally was brought to you by ERC buying put spreads on SPY. But why am I so bearish still? As we head into next week, it's important to remember for all investors and traders to remember what's coming. On Wednesday, the Fed will announce its next rate hike, and the stock markets have priced in a rate hike of 0.25%. And although it's highly unlikely, in fact, the odds are 99% that it's going to be a quarter rate hike, if Jerome Powell's unhappy with the amount of rally that he's seen in the stock market, it is possible that he could come out with a half-point rate hike. If that happened, you're going to see a sell-off unlike any we've seen in quite some time in the stock market, because it would be a complete shock. Although the likelihood, like I said, even I don't think is very high. Next week is also home to the earnings reports from the biggest tech companies in the entire S&P and NASDAQ. Apple, Amazon, Alphabet, Meta, all of these and more report next week. And so far, the earnings reports have been better than feared. In other words, they've been bad, but they haven't been as bad as the stock market had priced in. But if any of the big tech companies come out and disappoint even more so than what's expected, that alone could be a catalyst for a sell-off. And then when we back out on the macroeconomic environment, there's not a whole lot to be too bullish right now. Federal interest rate hike cycles often take anywhere between 6 months and 12 months before you see the effects of the rate hike, which means we're only now seeing the effects of the very first rate hike that the Fed did last year. Add on to that the rate hikes the Fed has been doing are historic. We haven't seen this kind of tightening cycle in decades, and you don't know what's going to happen as we go forward. However, like I always say, as an investor, I'm neither bullish nor bearish. I play both sides. So even though my own personal perspective might be bearish, I always have a plan for what I'm going to do if stocks go up tomorrow and what I'm going to do if stocks go down tomorrow. The other reason I'm particularly bearish is that I use anecdotal evidence from my own investments in play portfolio. My investments in play portfolio is my largest portfolio, and so I look at the top 5 stocks and see which ones are the leaders to determine whether or not we're in a greed pattern or a fear pattern. For the last few months, the biggest stocks in my portfolio have been Boeing, Dow, and Nike, and these 3 stocks represent more of a traditional view on the markets. However, since the beginning of January, that's changed, and now my 2 leading stocks are Nvidia and Apple, and this isn't really a good sign for a stable economy or a stable environment. To me, what that indicates is that a lot of people are coming on and buying the risk assets. Instead of being conservative, they think we're in the next bull market. So that's why I'm bearish, but let's take a look at both of my portfolios. We'll see who the winners and losers are and what moves I made this week. In the investments in play portfolio, this week's winner was Tesla, with no question, earning 33.31% in 1 week. Whether you're a bull or a bear on Tesla, it is one of the most rabid investments that you can even be involved in. So all the bears were betting that Tesla would have a bad quarter. Instead, Tesla reported a historic quarter and blew away all earnings expectations. This meant, in addition to new bulls wanting to buy the stock of Tesla, all the bears that had shorted the stock had to buy it to cover their shorts. And that's why you get such a big gain sometimes. This week's loser for a 2-in-a-row loss is Schwab, with another 3.02% this week off of its earnings from last week. That's how bad their earnings report was. It's also worth mentioning that EV maker Rivian saw a really good week, gaining 22.06% on no direct news for the company. The reason for this is that rumors started swirling that the Saudi fund that owns 65% of Lucid, another EV maker, was going to buy the 35% remaining. Lucid ended up going up 98%. Before closing 42% off of its low from one day on Friday, and it brought up the rest of the EV space. In this portfolio, I once again took more profits in Dow. You can see it's already been a busy year in Dow, but I took more out on the 24th with a sale that filled at $57.73. This sale lowered my per share cost 1.29% from $30.90 down to $30.50. And this was despite Dow actually reporting a disappointing quarter. This shows you exactly how bullish the market is. Dow had a relatively negative quarter and still rallied into the end of the week. Because I believe a big sell-off might be in store, I've adjusted my buy target to $40.71. This is actually below Dow's 2022 lows, and that's just because Dow's such a big position I'm not in a hurry to add to it. And I'll keep taking profits if Dow continues to rally, with my next sell target at $60.73. Next up is Take-Two Interactive, the video game maker behind Borderlands, Grand Theft Auto, Red Dead Redemption, and a whole bunch of other very popular video games. They rallied pretty significantly this week, so I took profits on the 23rd at $109.73. This locked in 19.64% in gains on shares that I bought for $91.72 back on November 8th of last year. It reduced my per share cost 13.74%. From $77.61 to $66.95. Because I have a relatively small position in Take-Two Interactive, I won't be taking profits again until it gets close to its all-time highs. I'm willing to hold on to this one for the long term. So my next sell target isn't until $201.56. However, my next buy target is $90.01, literally 1 penny above its 2022 lows. If it pulls back that far, I do want to replace the shares that I sold this week. Next up, let's take a look at the speculation in play portfolio. And I know this is what everybody's waiting for because this is the portfolio where I bought those faded put spreads. This week's winner, once again for 2 in a row, is Danimer Scientific, one of the worst positions in the entire portfolio. That being said, it did go up 10.36% this week and ended up being the week's biggest winner. It's also worth noting that Virgin Galactic is up 63.79% this year. So if you had any question about exactly how speculative the market has become and how bullish it is, there you go. This week's loser was one of my penny stock gold miners called Golden Minerals, and it dropped 2.03% this week because gold sold off. When gold sells off, the miners sell off, and I was actually surprised that this particularly junior gold miner didn't sell off more than that, so it held up pretty well. I did take profits in Advanced Micro Devices AMD this week on the 23rd with a sale that went through at $75.01. And even though this only captured 3.46% in gains on shares that I bought on September 22nd of last year for $72.50, I think AMD could test its lows, and the problem was it went much lower than I anticipated. As you can see, AMD hit its low on the 13th of October of last year at $54.57, but my next buy target is $56.51. And the reason for this is that AMD has regularly found support around that level, and that's where I'd be comfortable replacing the shares that I sold this week. My sale lowered my per share cost $105.01 from negative $35 to negative $135.01. A negative per share cost means that I've removed all the initial capital out of this position, in addition to $135.01 for every share that I still hold in the portfolio. Because of this, I'm not in a big hurry to take any more profits in AMD. I'm going to wait until it tries for its all-time high, with my next sell target at $164.99. I actually added to my Palantir Technologies position this week, and that's because we saw something particularly strange. It turned out the New York Stock Exchange had what they referred to as a computer glitch. Their explanation is that the order books that they held for 200 different positions were wrong going into the open. Somehow, they were missing thousands of orders, both buys and sales, so when the stocks opened, they reacted very crazy. And this didn't just happen in stocks like Palantir. It also happened in major stocks like Nike and Morgan Stanley. And it just goes to show why it's so important to use limit orders and not market orders. If you had gone into the open and saw Palantir Technologies had sold off down to $5.84 and put in a market order, the move happened so fast that you might not have actually gotten filled until $8.76. And then Palantir actually finished the day down almost 20% from that high. So you could have gotten in thinking you were going to get it at $5.84 and actually been down 20% on your position by the end of the day. And even in my case, I had a limit order at $6.20. And even though the opening price was $5.84, because of the amount of activity that was going on, I didn't get filled until $6.13. The benefit of a limit order is that if my broker couldn't have filled me at $6.20 or lower, it wouldn't have filled me at all. So I wouldn't have risked buying Palantir anything above my $6.20 mark. And this buy actually lowered my per share cost 5.27%. From $16.89 to $16 even. From here, my next buy target is $5.18, a price that I calculated using the Fibonacci method. And my next sell target isn't going to be until Palantir gets above my cost basis. Even though this is a speculative portfolio, it's still long term, so I do intend to hold Palantir for years to come. So my next sell target is at $16.48. So now the moment you've all been waiting for, I regularly say I don't short the markets, so why did I buy put spreads on the SPY on Monday? Well, there are a number of factors that went into this. First, I did it in the speculation and play portfolio. This is a really small portfolio. In fact, the entire portfolio is less than one allocation size of the investments in play. And it was exactly for reasons like this that I made this portfolio. I want to be able to screw around somewhere, but I don't want to damage any of my real portfolios that I'm going to need to retire one day. So I created this smaller portfolio so I could screw around. So going into this week with the S&P 500 rallying and volatility being under 20 as measured by VIX, which measures the fear in the market, and the lower the number, the less the fear. So when you're under 20, you should start looking at taking profits. And when you're over 30 or 40, it's a good time to start buying. And right now, we're right around 18 and change. When volatility is low, it also makes it so that the premiums that you pay to buy options are also low. So it's a good time to buy put spreads or add protection onto your portfolio. So on Monday, I bought the 400-398 March 3rd put spreads. For those of you who don't know, what a put spread is it means that I have the right to sell SPY at whatever price I buy the put. But in this case, I shorted a put $2 less than it, which means I've capped my upside. My maximum profit on this trade is the $2 difference between the 400 and 398 put spreads. So you might be asking yourself, why did I buy such tight spreads? Because the volatility is so low. After fees, these put spreads only cost me a little bit more than 74 cents. But they have a maximum profit potential of $2, which means it has the possibility to give me a 266.67% profit. Additionally, as I've mentioned before, I'm really bad at options. So rather than take a bigger risk, which could have a better reward, I wanted to risk less and still be able to have better than 2-to-1 odds on the returns. So if SPY, the ETF that tracks the S&P 500, closes anywhere below $398 by the expiration date of these puts, which is March 3rd, I get to keep the entire $2 in profit for each put spread that I bought. It's also important to remember that options are sold in contracts of lots of 100. So even though it says 74 cents, that's for one share. So overall, in order to get this put spread, it was $74.42 per put spread that I put on. For me, this is my way of getting back into using puts. So I'm using very low risk. I'm always more worried about my risk management than I am about the profits that I can get from a trade. So this is a directional bet. I'm betting that the S&P 500 will be lower than 398. And seeing as how its low was back here at $348.11 in October, if it pulls back significantly anywhere through the month of February and going into March, then I'll be able to capitalize on these put spreads. Stay tuned for that, because as always, it's going to be an interesting time. And the market tends to do the opposite of whatever I do when it comes to options. Again, why I don't do them very often at all. Thank you for watching. Please hit like and subscribe, and I'll see you in the next video.